Hello there, everyone. This is Sean, and welcome to Questioning Money, a newsletter taking a closer look at how money works and how it affects the world around us. Today, I'm going to talk about stock buybacks that companies do and why they do them. There's been a lot of conversation about businesses that buy back a lot of their own stock, but there's not a lot of conversation about why these companies feel like they need to. And even when it is talked about, it usually misses the point about how this relates to our system of money. So, to define it first, a stock buyback, also known as a share repurchase, happens when a company buys back its stock from the marketplace with the cash that it has accumulated. A stock buyback is a way for a company to reinvest in itself when they have extra cash. Since the company is buying back shares from people who are selling shares, they are accumulating more control over the company, meaning they own a higher percent of all the shares issued. And it also means that because the company is buying a lot of the shares that are for sale at all, buybacks remove a lot of the sell-side pressure on the order books, and the price of the stock often goes up since there's more buying than selling. So why don't people like stock buybacks, and why do we complain when companies do them? The criticism tends to come from the idea of greed, that the only reason for a company to buy back its own stock is to enrich the shareholders of the company, which mainly benefits the already well-compensated executives of that company. Why is it fair for board members to increase their already high net worth from rising stock prices while, for example, workers aren't getting a raise? This is compounded by the true fact that a lot of companies that have declared bankruptcy recently or were failing in the early stages of the COVID pandemic have bought back a lot of their own stock in the years prior. It just feels skeezy to see when a company has conducted mass buybacks and then had the gall to declare bankruptcy as soon as a little economic trouble came ahead. But what we have to get into here, and how it relates to our system of money, is why the stock buybacks actually happen in the first place. Firstly, in order to conduct a buyback in the first place, a company has to be profitable. There must be excess cash. Typically, when a company has a significant enough amount of retained earnings, they do one of three things. 1. Use that money to invest in the company directly, which could be anything like new buildings, machines, hiring more people, expanding research and development, or whatever. 2. They might issue a dividend, which means paying out that excess retained earnings among all the shareholders of the company. When a dividend is issued, it means that it's to the personal accounts of all the shareholders of the company, instead of being on the company's books itself, although of course the company holds some shares itself. This means that by issuing a dividend, a lot of the money leaves the control of the company. The third option is that they might continue to hold the money in cash, strategically saving it. So here's where things start to get interesting. Saved money, or accumulated retained earnings, doesn't always need to be immediately spent on the company itself. There might not be opportunities to expand, for example. Yet the company doesn't necessarily want to issue a dividend either, because they want to keep the cash in control of the company in case it needs to be used. Traditionally, this is where companies will hold large cash reserves. But a lot of these companies understand how our system of money works. They understand that money that's sitting in the bank in cash is losing value every year because of inflation. And while CPI inflation might be low, financial asset inflation is not. And the opportunity cost of keeping cash in the bank instead of investing it in the stock market is massive. Essentially, holding significant cash reserves is equivalent to holding a melting ice cube of cash, where every year that you hold the cash, you're losing more and more purchasing power. This has been exemplified even further over the last decade, and especially so in 2020, where the exponential monetary supply expansion that's been happening has directly led to high financial asset price growth. So, a lot of these companies know that keeping cash in reserves is a losing proposition, but they don't have anywhere to invest in the company internally or to expand. And they don't necessarily want to invest in the stock market in general, perhaps because by traditional metrics, a lot of the market seems overvalued and it's more of a risk. So instead of keeping their melting ice cube of cash in the bank, these companies invest and buy their own stock, which allows them to keep the cash within the company while still benefiting from the financial asset inflation that has come from a result of the expansion of the monetary base, i.e. money printing. Now, these companies don't deserve to be let off the hook either. If you use all your cash and don't leave yourself any sort of runway, then you're going to fail if there's any sort of market downturn. And that's what we saw earlier this year. Companies that didn't leave themselves any wiggle room for downturn by getting rid of all their excess cash reserves deserve to be criticized, and frankly, they deserve to fail. Having a company declare bankruptcy because they spent all their cash on buybacks before a market downturn is a sign of bad financial management at that company, and it deserves to fail, frankly. Bailing out companies that deserve to fail is one of the reasons why we have such a fragile economy right now in the first place. But back to the point, the way that our system of money so strongly penalizes holding cash is the reason why these companies are buying more stock back than ever in the first place. They realize that their cash is this melting ice cube directly caused by how our system of money works. And that is all for this issue of Questioning Money. Thank you for listening. You can find me on Twitter at Sean Cover. If you like the newsletter, please subscribe to get it sent directly to your email inbox every Monday. And I'll talk to you all next week. Take care.